Hey folks, it's Rob Flux here with another Sunday session, and today is a very special event. It's called Over the Horizon. This is where I give you my personal insights based on my 38 years in property, both property investing and property developing, with regards to how I personally read the market and where do I think that it's going over the 6 to 12 months period. Now, what is super important, folks, this is not me giving you advice. This is very much educational in nature, not advice at all. My encouragement to you is to have a look at the research that I'm actually doing and go validate this for yourself. I'm going to give you some insights into the methodology of how I read the market, because as a property developer, I'm buying in one market and I'm going to be selling into another market somewhere between, 12 months and 24 months from now. So I need to understand, is the market going up, down, or sideways? Now, you're going to see this particular thing. You're going to see how I interpret that. I'm going to talk about a thing called indicators, which what most of the market actually looks at. So things like, auction clearance rates, median house prices, all those sorts of things. That's what most of the market is actually using, but they are lagging. So they're telling us the market sentiment of things that happened 4, 5, 6 months ago. Whereas I use a thing called drivers. Now, drivers is what do I think is going to be moving the market in the next 6 to 12 months, things that are happening, in and around society. And so I break this down step by step. Now, this is actually going to be, a little extract out of a weekend event I did last weekend called Developer Launchpad. I did a very detailed section on that. So rather than me repeating all of that again, what I'm going to do is I'm going to flick over to that particular recording so you guys see exactly how I recorded it on the day. And then I'm going to come back at the end of it and give you the market wrap up. But in short, folks, I think that we are going absolutely to the moon. And for any of you who've been watching me for some time, I've been doing these, over the horizon, insights into where I think the market is going for the last 3 or 4 years publicly. I've always used this methodology myself personally and privately, but I'm just giving you the insights into where how my methodology works, and hopefully you guys can get something from it. So that said, if you think that you agree with me and you want to, try and take advantage of this from a property development sense, and you've never been in property development before, you're not sure whether or not property development is for you, then why don't you check out our free course that is going to give you, the insights into whether or not property development is a good fit for you. You might even want to consider coming to one of our, monthly events. We run these all the way around the country. We run them currently Brisbane, Sydney, Melbourne, and Adelaide physically, but you can also live stream them all the way around the country. And if you want to take your path to the next level, then you could also consider our 12-month education and mentoring program. That is called Property Development Formula. So you can check that out there. Now, that said, let's get on with the show. We're going to be talking about where I think the market is going over the next 6 to 12 months. Till then, folks, I'll see you on the other side. I'm going to give you the insights in how to read the market, depending upon whether or not you're a traditional investor or whether or not you're a property developer. What you need to understand, folks, is when you are buying into a deal today, it actually takes time to run the project. And so by the time the project is finished, we want to understand where the market is actually going, so we understand the market that we're actually selling into. So understanding how to read the market is one of the most important factors. Now, I want to give you some concepts, the difference between a property indicator and a property driver, okay? So indicators is typically what you're going to see out there, and this is what most market commentators will actually use, okay? And most traditional investors will use. It is measuring what has already happened. So things like auction clearance rates and median house prices, it's already happened, okay? And as you've heard heard previously, past performance does not indicate future performance. What savvy investors are doing, and you guys here, I'm going to give you the insights in how to do this. You look at market drivers. What is moving the market? What is going to predict how that will happen? Now, it's a little bit like a black art, and we're going to try and give you some insights into the black art so you know how you can do that. So let's look at market indicators in a little bit more details. This is what our property commentators use to report on what's happening in the market. It's typically what you're going to see the media actually start to do. The challenge is that there's a significant lag in the process. And the lag is not just in the results, but it's in the sentiment that happened behind the results. So if you think about a workflow as somebody wanting to sell, they start to think about selling, then they go and seek out an agent, then they start to prepare the property for sale, then they market the property and do the advertising campaign, then they do home opens, then a contract is signed, then you have to wait for settlement, and then and only then do you then see the results turn up, okay? So what you're seeing with an indicator is a sentiment of what was happening 6 months ago. And that's super important to actually understand. It is that lag in the system that is critical to understand. So some typical indicators that you may hear people talking about: listing volume, sale volume, stock on market, vacancy rates, auction clearance rates, vendor discounts, consumer confidence, buyer confidence, etc. Okay. This is typically what you're going to see every commentator. This is, I guess they're now called Cotality, but they used to be called CoreLogic. It's what they report on a regular basis, but it's got that lag, so understand that, okay? Now, if you're wanting a quick read on how to understand the market using an indicator, then I'm going to lean on the gentleman by the name of John Lindemann. He is a very strong property economist that has been in the game for over 20 years. I think it's close to 30 years now. This is directly from one of his blog posts. And it basically uses two of those indicators to actually understand the direction that the market is going based on the number of sales that are occurring and the number of listings that are actually starting to occur. If the listings are going up and the sales are going up, then the market is confident with where we're going. If the listings are going down and the sales are going down, then the market is very concerned. It's the crisscrossing that starts to become super interesting. If listings are going up, but nobody is buying, that is telling you that we're in a crashing market. And the reason is, with all those listings, all those things to compete, it only takes one person to become desperate to then drop the price in order to actually get it to sell, because there are no buyers. That then causes a cascading effect where the next person has to drop their price a little bit lower in order to get their sale, and it causes the market to drop. The converse, however, is when it's crisscrossing the other way. So the number of sales are going up, but the number of listings are going down. And the reason for that is that when the market is booming, people are wanting to hold onto their stock, not list it until they think they've reached the peak of the market. So they're going to hold onto it for a very long period of time. So if you see, this is giving you an indicator of where we are right this very second. But remember my comment before, it's a lagging indicator. So that means it's the sentiment of what was actually happening before. So if we actually have a look, these are the Cotality monthly chart reports. You can subscribe to these for free, and you can see from a listings volume perspective, we are pretty much down across the board in all the major capital cities. So listings, the number of listings is down. Okay. When we then go and look at the sales volumes, Perth is down, Adelaide's down, Brisbane's down, Melbourne is up, Sydney is down, okay? So the majority of them are down, but they're actually not down by much. And if you looked at this from previous months and previous quarters, you'd actually see that we are actually on the cusp of changing. So the sales volumes are starting to pick up, okay? So when we look at it using John Lindemann's scale, then we've got, so we're on the cusp of a turn, not the cusp of a turn. Bad spelling, Rob. So we've got Brisbane, Sydney, Adelaide, and Perth who are on the cusp of a turn, okay? So they're about to go into a boom phase. Melbourne already is in a boom phase, okay? Now, noting the lag that's actually sitting behind this. So we are at the bottom of what I think is a huge market actually starting to come. Now, you can start to see this is actually started to reflect in the changes in dwelling volumes over the last 12 months. So you can actually see that a number of these markets have actually started to lift significantly, but some areas are only going a little slow at the moment. So what does that mean? I think that the market is on the cusp of turning, but the question for you is, are they about to take off? And that's where the market drivers start to kick in. Market drivers is how we actually start to predict where the market is going, okay? So they are the cause of what moves the market, and it's what smart investors use to predict where the market is going. What's wrong with them though is it's a little bit of a black art to interpret. So I'm going to give you my system that I use. And not only that, but I'm going to give you my insights into how I see that. Okay. You have to pay close attention to all facets of the market. And there is no single data source. In fact, there are hundreds of data sources. It's taking me well over 250 hours to put together this particular content for you over these 2 days because of the sheer number of sources that are actually sitting out there. So to help you predict that, there are 4 key categories and 16 individual drivers. So first key category, government incentives, major infrastructure projects, and cash incentives and bonuses, okay? So we're going to go into those in a lot of detail tomorrow, specifically the cash incentives and bonuses, but you can see that the government is very motivated in doing stuff at the moment. Population growth. We already know that population growth is at all-time highs, but there's lots of different elements. There's birth, deaths, and marriage, there's per state, there's intrastate, there's international migration. Supply and demand. So development approvals is the potential for supply. Building approvals is the commencement about to start. Construction industry, health, and finance approvals is the last one. And the last one is our purchasing power. If we can't buy anything, if we're unemployed, if interest rates are too high, our affordability is too low, our household income and consumption, if we don't have spare cash in the system, we're not going to be able to buy. And then the RBA and APRA have what they call fiscal policies, which are then going to be determining what is next in the market. And they're giving you what they call forward projections on that. Okay. So they're the 16 areas. Okay. So we're going to use this and we're going to use our 16 drivers to predict the future. Then we're going to wait 6 months. And then we're going to look at the market indicators and look backwards. Remember that they are lagging. So we're going to look at the market indicators and see whether or not we were right. Now, if you do that process again and again, then you're going to hone your skills and you're going to use that like a crystal ball for you to be able to predict the future. Now, I've been doing this for, I'm going to say, about 15 years doing this particular system. And so far, I have not been wrong. And I've been through, in my lifetime, I've actually been through 3 different recessions. And when I go back and look back at all the indicators that were sitting back then, it proved to be predicting those as well. Okay. Now, I said this was a little bit of a black art. So I want you to actually start to think about a concept of headwinds and tailwinds. So imagine that you are walking down the street, and if the wind is at your back, then the wind is pushing you down the street. That is a tailwind. That makes it very easy to go down the street, no problem at all. Whereas a headwind is the wind blowing into your face and pushing you backwards. So whilst you're trying to go forward, the headwind is against you. So if it is neutral, then the market forces are having very minimal impact. And if it's location specific, then it might be a headwind in one area, but a tailwind in another. So for example, interstate migration, people leaving one state, that would be a headwind for that state, but where they land, that is going to be a population growth at this one, that's going to be a tailwind for that area, for example, okay? So when we start to understand that, what we do is we then start to map that out against our 16 areas. Now, given time, I'm not going to go through all 16, but I'm just going to go through the major ones that I guess are the ones that move the needle the most. Okay, and this is my predictions for the last 2 years or so. So you can actually see where we are. And what you do is you basically do a little bit of a tally, and you can see whether or not, so we can see right now, we've got tailwinds behind us in pretty much everywhere, except unemployment rates, okay, which are starting to rise, which means that everything is behind us, pushing us in the right direction. So what we're going to cover today is what's going to happen in the next 6 months and 12 months. If you are super pumped to actually see and understand how to do this, just type pumped into the window. Just let me know that you're alive and you're back from the break, folks. Soandeep, Annette, Ray, Juma, Vicky, Zoom user again. Very good, folks. Very good. Let's get into it. Government incentives. Now, I'm going to cover some of these today. I'm going to cover them in a lot more detail tomorrow. So right now, this is a little bit of a skim, okay? So infrastructure pipeline. This is major infrastructure spend that is sitting here And this is every single state government and their budgets with regards to how do they spend money. Now, this is in the billions of dollars, folks. Okay. So this is not chump change. And what we can see, so we are currently coming into Q5 of 2025. You can see that the infrastructure spend coming into the next little while is through the roof. Now, what this does is it creates jobs, and jobs then bring people to an area. And when people come to the area, they spend money in that area. When they start spending money in that area, businesses in that area then start to take off. And then when those businesses start to take off, they start to employ people. And so then people want to move into the area. So it activates the area. It's called trickle-down economics. So when you understand where the infrastructure projects are going, that's going to be the insights into where people are going to move next. Now, one of the biggest insights into that, so here's a list of all the infrastructure projects that are happening. One of the biggest things from an infrastructure project's perspective is transport, whether they be rail lines, whether they be highways, whether they be tunnels. They are the biggest amplifiers and biggest job creators in the country. Okay, and so you can see billions and billions of dollars being spent all the way around the country on this. As I said, this brings jobs and it activates the area, okay? These projects take years and years to roll out. Sometimes these projects are 3, 5, even 8 years long in order to get there. So those billions of dollars are spent everywhere, okay? Next up, there's federal government and state government incentives that are actually sitting out here. And again, we're going to go into detail on these tomorrow, but some federal government incentive programs. There's the Home Guarantee Scheme. So this is the ability to get into purchases, so into properties for as little as a 5% deposit and a 2% deposit for single parents, which means that they don't need to pay the lender's mortgages insurance. There's also the First Home Super Saver Guarantee, so the ability to take money out of your super fund up to $50,000 in order to come up with that initial 2 or 5% deposit in the first place, so you can actually pull it out of your super. Then there's the Help to Buy package. The Help to Buy package is where the federal government is actually going to be your joint venture partner, where they are going to take anywhere up to 40% ownership in your particular property. So you only have to pay the balance of 60%, I should say, which means that as the property grows in value, then the government share also grows, but means that you can get into a more expensive property than you might be thinking about. Okay, so these are being rolled out across the board, okay? On top of that, so all of those are activating buyers to be able to say the buyers can get in with less cash in the system, okay? So they need less deposit to start, okay? So first homeowners grants are also there. So if they are a first home buyer, then there's a whole bunch of incentives in Victoria, 10,000, New South Wales, 10,000, Queensland, 30, South Australia, 15, WA is 10,000, and that's typically got some conditions that are actually going to sit in there with regards to, does it need to be a brand new home? Is it something under construction? Those sorts of things, but understand that they are there. Okay. Then on top of that, there's the stamp duty incentives. So how do they actually start to discount the stamp duty? So Victoria has an off the plan stamp duty concession. So if you are buying anything with regards to a strata subdivision, so townhouses, duplexes, apartments, those sorts of things, then there is no stamp duty for you. So that is enabling all the stock that the majority of you are going to be creating is likely to have some form of strata. So in Victoria, the buyers don't have to pay stamp duty in order to get there. So if you can imagine no stamp duty and only a 2% deposit, wow, that means that people can get in with very little cash at all, okay? So New South Wales also has the First Home Buyers Assistance Scheme, okay? They're going to have no stamp duty on properties less than 800,000 and discounts if it's up to $1 million. Queensland has, if you're buying a new home, then there's no stamp duty if it's a new home. South Australia, again, no stamp duty there. And WA, the first homeowner rate. So no stamp duty if it's under 500,000 and concessional if it's between 700 and 750. All of this is to activate your buyers, okay? So your buyers are now able to get in with less deposit. So now serviceability is still going to be an issue, but now they can get in with less deposit. One of the biggest things is how long it actually takes to save a deposit. So do you think that is going to give you a lot more buyers to actually take on your stock? Just smash into the window if you think that's going to give you more buyers. Absolutely. Matt, Russell, Hester, Jumana, Shelley. Absolutely. Then there's the shared equity investment schemes. So these are state by state, slightly different. This is where the state starts to become your partner in the deal. So in Victoria, they'll contribute up to 25%, in Queensland up to 30%, in South Australia up to 25%, and in WA up to 30%. These are, I guess, that means that you can buy a bigger home because the government is now your joint venture partner in the scheme, okay? So now you can pay more for the property. Do you think that's going to mean that the amount of, I guess, the purchasing price that is needed is going to be higher? Yes or no? Do you think it's up? Hell yeah, everybody says. So now I can buy a bigger home. Now, I do have the government as my partner in the scheme, but it means I can still buy a bigger home. Means I can have the same size home with a smaller loan, which means that maybe my affordability can actually start to kick in as well, which is then one of those affordability drivers. So when we start to think about our market hack, if you think that this is a headwind or a tailwind for the next 6 to 12 months, type your answer into the window. Is it a headwind or a tailwind? Most of you are saying tailwind. Nobody's saying headwind. Tailwind, absolutely, folks. This is absolutely a wind behind our back. This is pushing us in the right direction. This is taking us exactly where we want to go. We've got more buyers able to afford to pay more money for our stock, okay? So if they can afford to pay more, then they're going to be able to afford to overcome some of the challenges. When we've got challenges with regards to cost of construction and things like that, and we have to sell at a higher price point, now we've got people who can actually afford to actually be doing that, okay? Next up is population growth. Now, I touched on this before with regards to our population growth before. We're projected to grow an insane amount, well into the 40 million mark by 2069, 2070 mark. This is our current population growth rate. You can see that we dropped majorly during COVID, and then we overcompensated, and we're coming back to some relative normality. But this is a telling tale that I want you to see here with regards to what our net overseas migration has been over the decades since the 1990s. And you can see that in the 2020s, we have been averaging 108,700 people per quarter in order to do that. Now, what this is actually telling us, folks, this actually equates to about 500,000 people per year, give or take, or very close, 450-ish. I can't do my math in my head. But this is becoming the new norm, okay? So I cannot stress this enough. This is the new norm with regards to the number of people that are actually coming in. All of that is going to put pressure onto the current limited stock that is actually sitting there, okay? Now, where are these people going? This is the most interesting part. Where are they actually going? This tells me that from an international migration perspective, so we're looking at the orange bars here, a heck of a lot of going to New South Wales, Victoria, Queensland, WA, and then South Australia from an international migration perspective. But the intrastate, so people leaving one state and moving to the other, a lot of people are leaving New South Wales because the housing affordability, and they're moving predominantly to Queensland and WA. That is the most telling tale. There is a small amount still leaving Victoria and a small amount leaving the other states, but it's relatively low. Queensland and WA are going to be the major winners of this, okay? So when we talk about intrastate, this is one of those location-specific type answers where it's a headwind for New South Wales, but it's a tailwind for someone like Queensland and WA. But they are overcompensating by the fact that they've got the international migrants to actually replace them. So it's not actually impacting them from a demand and a growth perspective, but it's still actually sitting there. So if I was to say to you, So intrastate migration, so that is from regional to city and city to regional, that's pretty neutral. But if I was to say interstate, if I was in New South Wales, is that a headwind or a tailwind? If that was in New South Wales, would that be a headwind or a tailwind? Headwind. If I was in Queensland or WA, would that be a headwind or a tailwind? It's a tailwind, absolutely. And international migration, is that a headwind or a tailwind? Where is that sitting? It's a tailwind, absolutely. You guys have got this. You understand what's actually going. Okay, so we can start to see a wall of green starting to come our way. So this is, can we meet the demand of what's actually happening? Now, I touched on this one before. Dwelling approvals, this is the potential for supply. Okay, now we need 60,000 homes a quarter for the next 3 quarters. That equates to 20,000 per month. Okay, so when we're looking at this on a monthly chart. 20,000 doesn't even register on the Richter scale. Are we anywhere near where we are? But what I can see here is an upward trend with regards to where we're actually going, okay? So the number of dwelling approvals is starting to come back, but it's not yet at the marketplace that we're going. But is it going in the direction that we're going? And is all the incentives, and this is the most important part, all the incentives that the government are doing, do you think that's going to create more dwelling approvals? When we're looking at predicting where this is going, do we think that's going to be predicting it? Okay. Now, the next is the completion rate. So again, we have not yet reached that 240 dwellings per annum for a while, but again, we can see a slow upward trend going in that direction. Again, if we're getting lots more approvals starting to happen and we got lots more people buying stock, what do you think the likelihood is that we can have more dwellings actually start to complete? So we're a long way behind at the moment, but do you think that all the momentum is going in the right direction? That is the question for you guys. Okay. So when we look at this, when we look at where we're going, dwelling approvals, okay? So from a dwelling approvals perspective, do we think that is a headwind or a tailwind? Karen, Abrimi, Andrew, Mark, they all say tailwind. Building approvals, do you think we're going to get more building approvals, noting that we've got more people likely to buy our stock? Absolutely. And from a finance approvals perspective, whilst I didn't look at the finance approvals, do you think if we can get in with such low deposits, do you think that is actually going to say more finance approvals are on our way? Headwind or tailwind, folks? Tailwind, as you can see, green lights across the board. This is starting to tell a very telling tale, isn't it, folks? Next up, purchasing power. Now, purchasing power does require a little bit of knowledge of how the economy starts to work, okay? So forgive me as I give a tiny little lesson here in what is the RBA, the Reserve Bank of Australia's monetary policy with regards to how they manage inflation and stimulate the economy. What they're trying to do is they're trying to get this slow, steady trajectory of us having a slow and steady growth. The challenge is it's near on impossible to get a perfectly straight line. So what they use is they use the interest rates to actually as a lever to speed up or slow down the economy, okay? Now, if we've got high inflation, okay, which we've just come from a high inflationary period, then typically we will have low unemployment, okay? But if we go the other way, if we've got low inflation, then we have high unemployment. So what they're looking for is Goldilocks right in the middle where there's not too many people unemployed because they don't want too many people on unemployment benefits and the economy is actually growing. So their job is to try and keep it in that sweet spot range. Now, the sweet spots range that they deem is between the 2 to 3% mark. And you can see here where our inflation is and where we've been tracking for quite some time. That target rate was actually introduced in 1992 by the Reserve Bank. And you can see how through monetary policy and both with RBA and APRA, they've been able to keep the economy largely within that band. Excuse me, folks. Sorry, I'm gonna. Excuse me, bless you. So you can see before, thank you, folks. Thank you, Linda. Sorry, folks. You can see before this yellow band down here, we were actually in some fairly difficult financial times previously. I mentioned that first slump of why development approvals didn't come through. Interest rates dropped all the way down to 0.25% at one point in order to try and navigate us out of that. Then COVID happened. We had the inflation that was caused by slowing down of our logistical supply chain and all that sort of thing. But they've now brought it back into range, okay? And so now their job is to start to slow it down. What they don't want it to do, they don't want to overshoot the mark. So in order to do that, they need to bring the brakes on. So somebody said lemon and honey. So I've got a whole bunch of strepsils sitting here and a whole bunch of lemon and honey sitting here. So thank you very much for those of you who are caring. So thank you, Matt. So what we're trying to do is to try and keep in that range. So that is the RBA's job. And so this is our current interest rates right now. That's our current interest rates, okay? So they are starting to try and lower those as we go. And then unemployment rates, as I said, unemployment is the impact of whether or not the RBA, if we have too much inflation, unemployment is one of those things that they need to manage. So you can see we don't want too much unemployment. If there's unemployed, people can't buy our stuff, right? So we need enough people in the workforce. So that's the magic that we need, somewhere between that 2 and 2.5% mark, okay? So this is, excuse me, a really interesting thing that the RBA starts to use to actually understand whether or not they want to start to use the levers. Now, I'm looking at these two up here. So we've got the blue one, which is our disposable income, and we've got the orange one, which is consumption, okay? And so where they crisscross is super important. And what we can actually see is our disposable income has started to actually lift, which means we can now start to buy stuff. And our consumption, we are not spending at the moment. So the government sees an opportunity at the moment. The government sees an opportunity to say, we're starting to save again. You can see before it was the opposite. They were consuming all the cash before. There was no spare cash. But now we're actually starting to get to a point where we start to feel comfortable that we can actually go into debt again. So this is where the RBA is going to start to go, right, now we're going to give it 1 or 2 maybe kicks, and we're just going to amplify that gap so that then people feel very comfortable to start to get back into debt again. And that is the key market driver as to when this is actually going to start to take off. The RBA's prediction, they have a thing called forward projections. When the RBA meets, they do an announcement of what they've done with the interest rate. And they also give you a forward prediction of what they think is actually going to happen, okay? So what they've said is the underlying inflation is back within range, but they need to ease it off slightly. But they've also noted that the monetary policy is well placed to respond decisively to international developments, which is really important because there's a whole bunch of things happening with Trump and the tariffs and all those sorts of things. And interest rate is the key driver to be able to do that. If they want to release the brakes, folks, releasing interest rates is the key thing that they can do to actually do that. So what they've said here is they're prepared and ready to actually make those moves. So no matter what happens next, we are in a really good spot to go. So when we look at CanStar have gone and polled all of the different big 4 banks. Commonwealth Bank said that they anticipate a 25% basis point cut in November, which is not that far away, which will then drop the cash rate to 3.35%. Westpac have said another one they've also said November, and then another one in February is what they're predicting. The NAB said the same, so they've said 25 in November and 25 in February, and the ANZ predicts just one. So all 4 of them are saying in November there's going to be another rate cut. So do we think that there's going to be an interest rate cut, folks? Yes or no? Now, if there is an interest rate cut, do we think that's going to make things more affordable? Can people afford a bigger loan at that point in time? Are they more likely to get into debt knowing that they can afford to do? Now, if we get 2 cuts, do you think that's going to open up again even further? So what it's really doing, we're setting ourselves up, folks. We're setting ourselves up. So when we start to look at this now, I didn't go into the APRA. So APRA, I guess, another portion of fiscal policy, but APRA's fiscal policy is fairly neutral. At the moment, they're not looking to change anything. What they can do is they can change the lending rules for just an individual category. So they could change that for the farming or the industry or for the property market. So they can actually just change how hard it is to actually get and qualify for loans. Okay, but APRA have been silent for the moment. Now, Adam says super boom. Oh my God. Sarah says to the moon. Alan's got a rocket ship there. This is what I'm telling you, folks. Where do we think interest rates are going? Headwind or tailwind? Everyone's saying tailwind. Unemployment rates. As inflation starts to get back under control, what happens to unemployment rates? They go up. Unemployment rates will go up. It will be a headwind. But the key to that is managing that headwind and making sure that it is relatively buoyant. Okay. So this is where we're sitting. So when I look at the chart, we've got a sea of green. We've only really got one red, and then we've got a location specific. So if I am in New South Wales, or more specifically Sydney, then Sydney has two headwinds, but 1, 2, 3, 4, 5, 6, 7 tailwinds. So 2 headwinds and 7 tailwinds. Do you think Sydney is going to go up? Yes or no? Absolutely. Now, if I was in Queensland or WA, where we don't have this location specific one working against us, we've only got 1 headwind and we've got 8 tailwinds. Do you think that is the super boom, folks? Yes or no? Tell me if you think super boom. To the moon, I'm telling you, folks, it is going to go absolutely ballistic. Okay, so this is where the market is going. Okay, now remember what I said to you before. Look at these drivers. Where do you think it's going? And then in 6 months' time, look backwards at the indicators to see whether or not you are right. If you keep doing that again and again, you're going to be able to refine your crystal ball, your future gazing potential. You're going to be able to refine that and see where we're going. Now, that said, the key takeaways. Population growth fueled by international migration is the major driver in demand at the moment. There is limited supply stock due to a combination of factors, but that is changing, okay? There's a likelihood of a rate drop by the end of the year is medium to high, and likelihood of a second one after that. There are massive federal and state government incentives to purchase new dwellings that's going to fuel the demand, subsidizing the purchases. And there's plenty of opportunistic buying opportunities at the moment with what is effectively turning the market. Now, there's probably one other one there, which for you guys is the fact that the planning rule changes. I didn't really put that on here. But all of that, folks, is telling us that we are on our way. So where do I think the market is going? Okay, basically, I think that we're at the precipice of a perfect storm of things that are actually all lining up for us. It is the opportunity for us to double our profits, okay? With all of the planning reforms coming, okay, that means that they're coming at such a rapid pace. 3 of them released this week alone, okay, that vendors and agents can't keep up with the rate of change, which means that you're going to opportunistically be able to find houses that the vendors and the agents think is just capable of a single house. But you're going to see that it can be capable of a 2-pack, 1 into 2 subdivision, a 6-pack of townhouses, all those sorts of things. You're going to see huge numbers of those opportunities where the market has not yet caught up, okay? But now is the massive time to take action, right? Because this opportunity to buy low before the market takes off is not going to last long, okay? So you're going to get your development profits plus the market uplift. Plus, and I should have actually put on here, plus the ability to buy low at the same time, okay, from an under-assessed asset. I think that we are going to absolutely go ballistic. Now, if I look at a normal market cycle, has ups and downs and peaks and valleys and all those sorts of things, but we did not have a normal market cycle. We had COVID, which was an artificial recession. Then we had the building boom. which was an artificial boom, which means that this was our market cycle this time around. So it wasn't as dramatic as a normal cycle is. So this period here, about 12 months from the bottom to here. And then this period here is about 2 to 3 years. And I think we are here. I've been calling this moment out for a long period of time. We've been on a slow climb up until now, folks. But I think that we are going to go absolutely nuts, okay? And I cannot stress enough. So Guy has just said a perfect storm. Indeed, my friend. There you have it, folks. That is my interpretation of where I think the market is going over the next 6 to 12 months. And as you can see, I think it's going to the moon. Now, that said, just want to reinforce this is educational in nature, not advice. I encourage you to go and actually look up these things yourself. That said, my key takeaway is in the 4 categories and the 16 different drivers. Government incentives. So firstly, government incentives. There is major infrastructure projects being done, which creates a huge amount of jobs, which means a lot of people with jobs can actually afford to buy stock. The next one, housing affordability. The government is printing cash. They are helping you get into properties with lower deposits, as little as 2% in some instances and as little as 5% in others in order to get in. There's incentives for stamp duty concessions around the board, especially for first homeowners, with both first homeowners grants and also stamp duty concessions with regards to that, meaning much more affordable to actually get in with less savings needed to actually get in. Plus, with the different state government and federal government home equity schemes, they are sharing the burden of purchasing the property with you. And as a result, it's lowering the amount of debt that you actually need, which means housing affordability is now coming to the masses, folks, which means we're going to have an army of people actually taking on our stock. Then, so that's infrastructure. That's I guess the affordability side of things covered. Then we've got a massive demand. So population growth. So we've got international migration at all-time highs, which is creating a huge amount of pressure with regards to houses being needed. 1.2 million homes needed over the next 5 years, which we are, I guess, not on target to actually reach. So they are incentivizing us to try and resolve that in a whole bunch of ways in other elements. I covered, I guess, the government incentives with regards to planning schemes separately on that Developer Launchpad event, because every single state, federal and local government is actually trying to, I guess, give us massive, fast track approvals and higher densities to create the right stock in the right place. So know that that's coming with regards to improving the supply that's coming in here. So that's I guess the supply and demand side of things. So all this legislative changes coming through was initiated originally by the Housing Accord back in August of 2023, has taken some time for the machinery of government to roll that out, but is now starting to come with gusto, I guess, and we're seeing fast track approvals in as little as 10 days in some instances, depending upon the stock that you're actually trying to create. And in some instances, a pre-approved, designs and that sort of thing, which means you don't even need to go get council approval at all. So they are massively providing, removing all the red tape and bottlenecks with regards to going here. Lucky last is, I guess, the affordability side of things with regards to the cost of actually getting into things. So interest rates are, I guess, looking like they're actually going to come down. All of the big 4 banks are predicting interest rates to drop again in November, and 2 of those are predicting a second drop in February. All of that said, what it's doing is creating a perfect storm for, I guess, the amount of demand coming, and what you need to do as a small-scale property developer is to actually create the stock for them to actually take that demand. Now, if you are new to property development and you don't not sure whether or not this is a good fit for you, I just want to let you know we have a free course that you can actually do to actually learn about the property development process and see whether or not that is actually for you. It's called the 7-Step Formula to Financial Freedom. Equally, we run meetups all the way around the country in Brisbane, Sydney, Melbourne, Adelaide, and soon to be Perth. They are physical in nature. You can turn up to those in those jurisdictions. Plus, we live stream them. So no matter where you are in the country, you'll be able to participate in those. So we run 45 events of those every single year. And if you want to take your property education to the next level, just reminding you, we do have a 12-month education and mentoring program. It is called Property Development Formula. So hoping that you get plenty from that. Now, that said, folks, I'm hoping that you've enjoyed this show and that you've got plenty out of that. And I hope to see you at one of our upcoming meetups. And until then, I'm going to say bye for now. Bye, folks. Bye.